In very layman language, can you explain to us what exactly a special fund is and why they are called special funds?
So special funds are kind of unit trusts. They're all collective investment schemes.
Okay.
You have money market funds, you have fixed income funds, you have balanced funds, you have equity funds. They're all the same in the sense that they're all governed by the collective investment scheme rules or regulations by the Capital Markets Authority. Now, special funds are added to those, and they're called special because they offer a lot more flexibility around investing.
Where exactly are you strategically investing money?
We're investing in still bonds, local, but also other sovereign bonds.
Okay,
internationally. International equities, local equities, but those have done really well. We're also doing derivatives. So when somebody says, oh, can you lose all your money in a special fund? I would say no, unless there's fraud.
Who would you advise to take on a special fund? Are there things that someone must have already done or put in place to consider, let's say, special funds as part of their portfolio?
Yeah. Yes. So first of all,
Hi everyone, welcome back to another episode of Finance Friday. My name is Coach Susan, and as per usual, I'm very, very happy to have you guys on here. Now, as per usual, we are shooting at my favorite spot, Sarova Pan Africa. And if you did not already know, Sarova has one of the most amazing conference packages or facilities that I have personally worked with. Last 2 months ago, we actually had our first ever women's only CEO event, and it was amazing. The food, like everyone was actually raving about the food that we had during our event. We actually had like breakfast in the morning, we had 10 o'clock tea, we had good lunch, we also had like some really, really nice snacks even towards the end of the day. I love that they're able to literally customize whatever it is that you need for the conference rooms. The responsiveness was amazing. So if you're looking to do an event, whether that's like a private thing with your friends and family, or if you're looking to do that as a creator or even an event organizer in the corporate space, feel free to check them out. For a while now, I've been getting questions about special funds, and you guys are asking me, Coach Susan, what do you think of Mansa X Fund? What do you think of Oak? What do you think of the special fund that Kuza has? And I really didn't want to specifically just begin to talk about it without bringing an expert on board, because as you guys know, special funds are actually a new addition in the Kenyan space. They're relatively new. We are getting to just learn about them and interact with them maybe in the past 4 years or so, because I know like Mansa, for example, started in 2018. So today I'm going to be talking about special funds, but I'm not just going to be talking about it by myself. I've brought an expert that has actually been in the market for over 20 years to help us understand special funds in the Kenyan space. So if that's something that you've been looking forward to learn and to understand, keep watching. So when I thought about this whole conversation around special funds, I thought of the perfect person to have this conversation with, and that was none other but Rina Hicks. So I'm very, very happy to have you on set today, Rina. I was just telling you that I don't think I can do any introduction justice. You're such an inspiration to me and a mentor as well in the industry. So I'm so honored that you agreed to be here. So please tell us a little bit about yourself, what you do, and we can get started after that.
Awesome. Thank you so much for having me. It's such an honor to be here.
Yeah.
You've done so well, and I'm so proud of you.
Thank you.
So proud. My name is Rina Hicks. I have been in the investment management or investment banking field for the last 21 years.
Yeah.
I am the operations director of a company called FIDA Investment Bank, and we offer various financial products, from stocks, bonds, stocks or equities, investing in collective investment schemes, which is Oak Special Fund is one of the ones.
Yeah.
And we also do corporate finance, where we advise companies on raising capital, on mergers and acquisitions.
Oh, wow.
In fact, that's I lead the team in corporate finance at FIDA as well. So yeah, so that's what I do.
I'm learning new things. I didn't know that.
Yeah.
Oh, that's amazing. Can we get into this special funds conversation? Yeah. In very layman language, can you explain to us what exactly a special fund is and why they are called special funds? Like, we have the unit trust funds, we have equities, we have whatnot. Why specifically special?
Yeah. So special funds are kind of unit trust. They're all collective investment schemes.
Okay.
You have money market funds, you have fixed income funds, you have balanced funds, you have equity funds. They're all the same in the sense that they're all governed by the collective investment scheme rules or regulations by the Capital Markets Authority. Now, special funds are added to those, and they're called special because they offer a lot more flexibility around investing. When you look at all these different ones, they all invest in the same asset class or same kind of asset classes. So generally, there are 5 kinds of asset classes. You have cash and cash equivalents. Then you have fixed income investments. You have equity investments. And then you have alternative investments. So now, each of these ones have their specific asset classes. So like a money market fund, it will be cash, cash equivalents, and maybe short-term like T-bills. If it is equity funds, it's generally equities. Although, of course, you can have money in in cash. So a special fund allows you flexibility across asset classes, across even markets. Like, you can go to Uganda and trade there. You can go to Ghana. You can go to the US. So it's across asset classes and across markets. And that flexibility is what makes them really interesting. So the name special fund was coined by the Capital Markets Authority as the kind of unit trust or collective investment scheme it would be. So when you name yours, it would be whatever it is, but it's actually a special fund.
Special fund. That's amazing. What makes them different from all these other collective investment schemes that we know is the flexibility.
Yes.
To go even out of the Kenyan jurisdiction to invest elsewhere as well.
Yes.
Is there any other thing that makes them different?
So because of that, the element of risk is generally a little more than, for example, the money market fund, in the sense that with a money market fund, you know that I'm investing, I can get my money at any time, and it will be close to, the last month's performance. Whereas this one, the returns are likely to be potentially higher, but they could also be lower. These lock-in periods and so on. And also the kind of investor that would be investing in a special fund is required even by law to be a little more sophisticated than one who would begin with a money market fund. So the sophistication of an investor as defined by the Act is one who can invest a minimum of 100,000 shillings.
Okay. Since you've been in the industry for quite a while, and these special funds are a new concept as far as I'm concerned. What would you say has necessitated the need for it? What about the times we're living in, or the investment landscape, made the investment industry or investment bankers sit down and be like, okay, we need to introduce this kind of a product. What was the gap, or what's the gap that special funds are coming in to address?
So I think generally in the past, what has been available in the market in Kenya has mostly been around equities for a long time. I mean, when we started the investment bank in those early days, it was mostly equities. And so Kenyans understood equities. My grandfather, both my grandfathers for my both parents had shares in ABL, in KCB, in, all these different companies. They understood shares because it's simple. I own a company and the company goes up in value and so on and so forth. However, over time, we found that fewer and fewer companies are listing on the stock exchange here. But even when you look globally, by the way, the rate of increase in listings across the world has slowed down. And we're having even more delistings generally. And there's been a rise over the years in private equity. So companies are preferring to go to private markets to raise capital. And the impact of that is therefore then you find that the companies that are available on the market, let me talk about Kenya, are fewer. And then because of economic challenges. So if you talk about from 2007, for example, and you try and map how the performance of the market has been, there are companies that have never gone back to the high that they were in those days.
That's for sure.
Right? Yeah. So there's people who got jaded. And that's like, I can't invest.
I can never.
I am not investing in stock market.
Yeah.
And so then where does that leave them?
Exactly.
Okay, so then there's real estate. Real estate is fine. It has done fairly well. However, when you want to sell, it would take a minimum when you have a buyer of 90 days.
Of course.
So the gap was, how can I find an investment opportunity that is suited to my risk profile, but at the same time gives me reasonable return, and I don't have to think.
Yep.
So I used to tell people, you need to understand what you're investing in. Can you analyze those companies? Talk to your broker and But people don't have time. So that's another issue where there's a gap, where I don't have the time. I'm a mother, I have kids, I'm working. You know, by the time I want to sit down and look at my finances, like I can't start analyzing.
Yeah.
So how can we then create collective investment schemes that then allow another party to do the thinking for you?
Yep.
So you have active managers, portfolio managers, people who have been to school, understand, and every day they're analyzing and making decisions. So we found that that was the gap that was missing. And money, and then I guess finally, there's just been an increase in financial literacy.
For sure.
At least in the last 5 years.
In comparison to before,
right?
For sure.
Yeah.
Yeah.
So, I mean, thanks to wonderful people like yourselves, people have become very savvy. They'll come to the office and they'll be like, no, I know this is blah, 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 blah.
Yeah.
So there's a lot more demand in the kind of products that people are looking for. In addition to that, going into things like crypto, investing directly in US markets, young people are a lot more savvy. So the question has been, how can we in the market find a way to create products that are relevant, easy to invest in, but at the same time give people relatively good returns that don't make them have to figure out, where do I invest my money? Yeah.
Awesome. So obviously we can't talk about special funds and definitely not talk about Oak. Okay. Yeah. So you work at FIDA Investment Bank. You guys have Oak Special Fund, which is what I would call like a very it's among the rock stars that now we know in the industry. Could you take us behind the scenes, because of course we're gonna get into it. I am very curious about like, how are you guys investing? Where does Oak make its return from? Because I know your annual target right now is around estimated at 20% per annum return.
Yes.
20.
But it's a target.
It's a target. That's why I said it's a target. Yeah. So where exactly are you strategically investing money?
Yeah.
Because obviously that's not the typical return we have in like our market in terms of like collective investment schemes.
Yeah.
Your typical money market funds are like, I mean, right now zimeshuka, give or take maybe 9, 10, 11%. We have our bonds. So, you know, when you're working with a target of 20% in a special fund, and that has been the greatest concern, all the questions that I get regarding the special funds is, Susan, I get it. They're good. They are, they're helping me diversify my portfolio. But 20%, 17%, 15%. So where exactly is,
yeah, so that's not an unreasonable return, because it's per year. Okay, so when you think about what are we doing?
Yeah.
To be honest, it's different in different seasons. Okay, so let me give you last year as an example. Last year, so generally what happens with special funds, you have to come up with an investment policy document that specifies, this is who we are as a special fund. This is what we will invest in within these parameters. And that document has to be approved by the Capital Markets Authority. So you didn't just decide in the morning, we will buy.
This is what we will do.
No.
And that's every year? Or just
so before you start
at the inception.
Okay. You have to declare what you're about, what are you going to invest in, and how you're going to make your returns.
Okay.
And what proportions are you going to invest in between this and that. Now, that still offers you flexibility, because let's say if within my investment policy document, I can invest 70% in bonds, it doesn't mean I have to. it's up to 70. So in the season that I am in, I can then make decisions where to allocate. So let me give you last year. Last year, 60 to 64% of our fund was invested in bonds towards the end of the year.
Local bonds?
Local bonds.
Yeah.
And we saw an opportunity. If you remember February last year, we had bonds, the infrastructure bond, if you
all-time high,
18.4%,
yeah,
tax free. And we're like, these rates are not sustainable.
Yeah.
It's likely they'll start to fall. So we started to buy bonds. And over time, what we found is that when bonds, what happens, there's an inverse relationship between bond
prices and rates,
the yields and the value of the bond. So when interest rates go up, the value of the bond comes down.
Yeah.
When the interest rates go down, value of the bond goes up.
Yeah.
And so because of that, as the value of the interest rates was coming down, the value of the bonds were going. We made really good returns in bonds as the year progressed.
Yeah.
And then rates went significantly down after October last year.
Exactly.
So that's how we made money last year. We actually gave a return of 29% last year.
Wow.
After fees.
Wow.
Now, this year has been different. Okay? This year, there's been a lot. Whether we're talking about currency is 129.7 to 29.70, 129.65. Like, there's not much fluctuations
happening.
FX. Interest rates have sort of been also kind of been, sort of steady. And so we've had to be, where else now can we invest? So our allocation to bonds has reduced. Also, the fund is growing, right? So we are now at almost 6 billion assets under management.
That's awesome.
It's fantastic. And I'm so grateful for all the clients who've been able to trust us and have invested with us. But, as the fund also grows, you have to figure out, how can I remain consistent in my returns? So not take too much risk, but at the same time seek returns.
Yeah.
So now we're investing. This is where we're investing. We're investing in still bonds, local, but also other sovereign bonds.
Okay,
internationally. International equities, local equities, but those have done really well this year.
Yeah, this year it's like boom.
Yeah, those have done really well. Last year we were like, but this year those have done really well. We're also doing derivatives.
Awesome.
Yes, we're also doing derivatives.
Okay.
So those are the ones that also help to give some returns. And CFDs. CFDs are forex trade.
Yeah.
So yeah, I think we can't say to this month we made money from this, last month we made money from something different, and so it keeps changing.
Yeah,
depending on the markets, depending what we're looking at and seeing as the opportunities coming forward, and then how much money have we made. So I was actually telling you earlier, when you grow by 1 billion in 1 month, even if you've made 20% that month and the billion comes,
it's diluted.
So now we're not making money. But from a client perspective, Susan Wanjiko's account will show maybe 20% or 19%, but the fund return may show 17% because the fund has been diluted by more money coming
injections.
Yes. But that's why we're making returns.
I love that. Okay, so obviously, there's this common rule of investing: the higher the risk, the higher the return. Yeah. Does a higher return always automatically mean that my money is, exposed to more risk? Because can we talk about what should someone's mindset be around the aspect of risk and return when it comes to special funds? What would you want a potential client to know or to understand about the concept of risk and return when it comes to special funds?
Yeah, that's a great question. So first of all, in terms of the different funds, because I can just compare them with the other funds. If you look at money market funds, they'll be the lowest risk under money market funds. In fact, collective investment schemes. In fact, in my view, you're better off in a money market fund rather than buying one bond because of diversification.
Exactly. Yeah.
So if, let's say, things were not so great, like happened in Ghana, and I have a certain bond that the government decides they're not going to pay back, then it becomes an issue. So money market funds, I would say, in terms of the collective investment schemes, are lowest risk.
The lowest risk.
The next one is fixed income funds. Although you find the return is not so great, but it is the next one. Now, equities, I think, come after special funds in terms of risk.
For sure.
Yeah.
Because it's stocks.
Yeah. But the special fund is diversified. Actually, that's one of the greatest advantages of a special fund because you diversify across asset classes, meaning your eggs are not all in one basket.
Exactly.
You've got cash, you've got bonds, you've got equities, and then some other ones where you're taking a bit more risk.
Yeah.
That way, then it's a great balance between you taking risk, but also safeguarding your investment.
Exactly.
And so when somebody says, oh, can you lose all your money in a special fund? I would say no, unless there's fraud.
Okay.
Unless there's fraud or misappropriation,
Yeah.
and just utter bad management, right? Like somebody just wants to steal. That's when a fund would go down. But honestly, if a fund is being well managed, well regulated, there's no, how can you lose all your money? Returns can go down. You can get minus something, but you can't lose 100% of your money.
Yeah, like the initial capital you did was like 2 million, and now you're like, oh, we don't have 2 million for you.
Yeah, because some of that money is in cash. Yeah, some of that money is in bonds. So it's diversified. So it's also good as an investor to look at where are you investing money? And these questions you're asking are fantastic. And to look at, we have documents called fact sheets that explain where we are investing our money.
Literally on most websites of all fund managers.
You can And then if that's not enough, because sometimes these fact sheets are developed quarterly, what you could do is also just make a phone call, speak to a fund manager, speak to you can speak to our team and find out where have you invested.
Yeah.
We can arrange meetings so that then you're able to understand where is my money
going.
What is it doing and how are you making a return, so that as you're investing, you have understanding. Yeah.
Okay. There's been definitely a worry, especially because with special funds, we are going outside of the Kenyan jurisdiction.
Yeah.
And I think a big selling point for most special funds that I have seen is that we are also granting you access to global markets, right? With that comes a worry, because we've seen other global markets collapse before, or scenarios where, something catastrophic happened and the fund either collapsed or people lost money. In fact, the other day I was having a conversation with a client who was like, son, the way the POTUS, is whatever is happening in the United States of America, is affecting the markets and whatnot. What does that mean for me as an investor in a special funds that is, has given us exposure to the New York Stock Exchange, the London Stock Exchange, the Tokyo Stock Market? How is there, how would you address that worry that, especially because it is going to the global markets, then my money is exposed if there's wars, if there's, someone said that, America sneezes and the whole world feels it, catches a cold. How would you respond to that?
So first of all, I need to explain, we don't hold assets for long. Our goal as special funds, generally, let me speak about ours because I don't know about how others' strategies. Our goal is to trade. It's in, out, in, out. The in, out may be in 3 months. In, out might be in a week. Yes.
Okay.
The in, out might be in 2 months. So we don't sit and hold for 5 years. That is not what we do.
Okay.
I think the longest, we generally don't buy and hold and sit in our strategies to earn dividends because we have to give returns.
Okay.
And so and then secondly, it's actively managed. We have dealers who are, and we have, how many dealers do we have? Like now for us, I think we have about 7 dealers who sit and every day know exactly what they're doing. Every Tuesday, they have to give a report. What am I planning to do, coming week? And what's the plan? And of course, we sit and re-strategize. Figure out this is what has happened. Do global events affect performance? Absolutely. I'll give you an example. On the day that the US president announced the tariffs, I think it was March. So it was like 28th or something.
Yeah, towards the end of
March.
Yeah.
We were holding the Eurobonds, Kenyan specific. And we experienced some interesting increase in the yield
Really?
of Kenyan Eurobonds specifically. Yes.
Why?
Well, because you see, what happens when you trade, sometimes reactions to news or announcements may not necessarily be very rational.
Yeah.
It's like, what's likely to happen? Who's going to suffer? Oh my gosh, let me sell, whatever. Let me exit, let me get out. And that then causes a lot of supply in the market. And so then prices shift.
Yeah.
And so those prices shifted. And did they affect us? Yes, they did. But was it significant? No, because first we're holding a small percentage in our portfolio and we're diversified. So yes, maybe our return could have been 20%, but then maybe it was 19.8. You see what I mean?
Okay, yeah.
So in terms of the impact of that on the entire fund is less because we're diversified. So I think I hear you in terms of global events. There are some events that can significantly affect, like if we go into war as a country.
Yeah.
If we go into war and our whole team dies, we have no more traders.
So that is the scenario that would actually, not that, you see like how the US bombs Iran, whatever. Does that, because I feel like our understanding of, okay, but this money is in the global market, our understanding from what I've gathered, especially in conversations with people who are like, yeah, I hear you, but like they're on the fence. It's like whatever is happening over there, even though we are peaceful here, will affect my money because my money is there.
Well, it's true, but it's true it does affect. The impact, the size of the impact is the issue. Because we don't have all your money out there.
Yeah.
As I told you, like last year, 60% is in bonds. And then we've got all these different assets, probably like 1 or 2% that will be in that specific investment that is affected. But the proportion that will be affected is not that great to then result in significant losses in your portfolio.
Yeah. So we are worried about worst kind of scenarios.
Yes, we're going to war first as a country because majority of our assets and expertise is here. So if traders can't trade, if something happens and they're not able to exit positions and things like that,
that's what would
cause huge.
But not necessarily like there's drama over there and we don't have drama over here. Oh wow.
Although drama there affects. So like now if let's say drama there then affects ability for Kenya to access funds.
Yeah.
Now we're not just sitting and waiting. Oh, let's wait and see what happens. Oh, that's interesting.
Yeah.
It's okay, guys, let's sit down, figure out what does this look like? What are the potential scenarios? And then make a decision. Are we exiting? Are we buying? Where are we moving our money to? And so on to avoid significant losses.
I love that. Can we talk about regulation?
Absolutely.
What does CMA regulation look like? And what are the protections around like protecting investor money when it comes to special funds? Can I would like to actually give you like a backstory of a conversation I had with a client so that you can use that maybe to help us understand regulation, not just for special funds, because I feel like there's a gap in how we understand CMA regulation. Yeah. So some time ago, I was having a conversation with a client who has invested in a fixed income fund. Yeah. So as you've said, financial literacy right now, it's at an all-time high, and we thank God for that. So obviously, like people are doing more of reading like their documents, like their investment documents and whatnot. So she came across a clause that worried her because it said something like the Capital Markets Authority does not guarantee the financial soundness of this particular and then of course withdrawal of units at a given point could even be suspended for a reason or the other. So she was asking me, Coach, what does this mean when you say they don't guarantee the financial soundness of the investment? And that took me on a rabbit hole and I mean, I learn every day in this industry because
me too.
Even for me, that was the first time. And I like that day I saw it on almost all documents, whether it's a money market fund, whether it's most unit trust mutual funds documents have like that clause over there,
and it's a requirement by law for us to have that clause there,
so now I began to investigate for myself and to even kind of like, okay, I think we need to learn or try to investigate if we really understand the role of the CMA in terms of regulating a fund and what that should tell me as an investor, right? So I wanted to give you that background so that you can understand where I'm coming from when I ask, what does CMA regulation look like for special funds?
Yeah. So maybe let me just explain first the CMA, and then I'll come to So the CMA is really about ensuring that our capital markets is run in a transparent way, and that there's investor protection, and that the market is deepened in terms of offering products that make sense for Kenyans to be able to save, invest, because when they do that, then we generally are able to have capital as a country to finance businesses, to finance government needs, to be able to, when capital is available, then a country functions much, much better. Now, when we talk about investor protection, it doesn't mean that they're in our office every day asking us, what have you bought? What did you sell? At that price. Why did you sell at that price?
Not their job.
No, because we're professional. Right? What is their job? Their job is to make sure that these people who are claiming to be professionals, first of all, they are. In order for you, if you tried today to set up an investment management company, there's something that you will have a form that you have to fill out. What are those forms called? I'm forgetting the name, but it's a form to ensure that you put in your details as an individual. Are you the right person? They even make calls to find out, you left such and such company. What was the issue? Or get a letter from that company saying, yeah, this person worked here. I have no issue with them. They were fantastic, or whatever it is. A recommendation letter is given to the CMA. So that at the first level, are the individuals we have given licenses to run, are they capable people? The second thing that they do is make sure that the products that are being offered, whether that product is a commercial paper, it is a bond, it is shares that are being sold, that those products make sense, the valuation makes sense, the manner in which they're being sold makes sense, and that there's truth in what is being expressed. So they even look at information memorandums, prospectuses, they check. You're saying this is not correct. This valuation is too high, blah, 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 blah. You know, they give feedback and they say, no, go back, fix this. This is not going to fly in the market. This is not truthful, blah, blah, blah. They do that.
And this is even before you are licensed. Before they say, okay, fine, proceed.
They check that. Every advert, all right? Every advert, if there's a company selling a commercial paper, if there's a company, like even for us, in order for us to put out content on YouTube, to put out content on a newspaper, CMA have to have an idea of what we're doing. The regulations require every licensed person to get approval for communication before it goes out to the public. It's just how it is. Now, do people obey? Now, when they don't obey, there's something called enforcement. That now CMA will come in and take action, and enforce. Now, there's people who come and say we are regulated, and sometimes they're not. Or there's a product that is regulated, and sometimes it is not. But today, it's so easy to check. You just go on the CMA website, type who is regulated. All the products are listed, so it's easy to check. So that's the CMA. And it's important, first of all, to understand where their role begins and ends. Now, it's for us as professionals, because we're not in the business of losing people's money and making them very frustrated. We're here to make dreams come true. We're here to partner with our clients to help them to get to where they want to go at the end of the day. So we then have to ourselves have systems, like we have risk management, we have governance, we have an investment committee, we have a team. There's, governance in terms of just checking what are these guys doing and where have you decided to buy this, or what are you doing this month, and so on and so forth, to ensure that things are done well. Now, in reference to this story that you've given me, as investment professionals, we don't know what's going to happen tomorrow. What if the government defaults? I can't. Where am I paying you from? The money you gave me, I put it in
the bond.
In the bond. I put it in Ghana, in the bond in Ghana. And the government defaulted. So where am I paying you from? So it's in those instances, you have to look at worst case scenarios. What am I committing to do as an institution? Because if I commit to pay you back and I say I'll pay you back all your money, I have to know very clearly and even have that money somewhere sitting to pay all my investors back should this thing not work.
Exactly.
And so to avoid that scenario, we have to put it out there. These are the risks you face. You could lose 25% of your investment. We could delay you getting your money back. Because we don't know, right?
Yeah.
We don't know. What if, you remember what happened with Chase Bank?
Yep.
The money is available, but Chase Bank has gone under.
Yeah.
So what do we do? You understand my point? One of the things people need to understand, there's no such thing as no risk.
Ever. Even in a bank.
Especially in a bank.
Right?
Yes.
Yeah.
You're even safer in a money market fund
than in a bank.
You know what I mean?
Yeah. It's so interesting that you say that, because the reason why the people who don't even invest in money market funds don't invest in money market funds is because of the illusion or the belief that, but my money is safe, where I can log into my app right now. I see, oh, I have 20 Gs, I have 80. I feel like, okay, it's there. But is it though?
Well, we know it's not, because banks use your money to lend to them.
And this is some of the things that I'm just like, and we thank God for literacy, because again, it's very interesting when you have this conversation with, people. And I realize so many of us do not know that, like, your money is actually not there. Like it's they're lending it. Exactly. People are taking out mortgages. People are taking out, they're financing. Loans make banks the most money, if I'm not wrong. Yeah. That's interesting. So I want to talk about the risk just a little bit more, because when we talk about investor protection, and when we talk about, okay, there's this risk associated. If I was to come to you, maybe you can take me like as a, client X, right? And I'm coming to you and I tell you, okay, I'm interested. From the perspective of an investment advisor, who would you advise to take on as special funds? Are there things that someone must have already done or put in place to consider, let's say, special funds as part of their portfolio? Yeah.
Yes. So first of all, we have a lock-in period at FIDA. Our Oak Special Fund has a lock-in period of 6 months. And so before you come into a special fund, one of the things I would recommend that you do is first have an emergency fund. Some money, a buffer, an account where you have some money. If something goes wrong, you can, tap into. The second thing I would say is, whatever you're investing in a special fund, have an investment horizon of 1 to 3 years.
Okay.
Because even when we talk about even 15% return, when you look at 1 year, but if you're able to keep investing and so the second thing is be ready to top up.
Yeah.
Because the more you top up, the more money compounds. But if you put 1 million, you see, say for 2 years,
nothing.
Yeah. You won't really see growth. And the reason we say Jilipe or pay yourself first, the reason we're like, this is our campaign, Jilipe, because the gain, and this is from my personal experience, gains and growth in your personal finances comes from the consistency of investing.
Exactly.
And putting aside. So as you start, it's important to know first, I need to make sure that I have some money for emergencies. It's also good to have money available in, let me say, an insurance policy for health.
Yeah.
Healthcare needs to be taken care of. And of course, depending on your circumstances, there's other potential insurances that you should get. To prevent the issue of risk happening, or rather, to cover you should that potential risk occur. But beyond that, once you have at least 1 to 3 months emergency, it's okay to invest in a special fund. And of course, it depends on your age and your personal circumstances and so on. So for example, it could be a stay-at-home mom. Husband provides everything. She doesn't have an emergency fund. She can invest in a special fund. Why? Her husband is the emergency fund.
Right.
So it depends on your circumstances also.
Yeah.
It can't be that this is blanket for everyone. So of course you have to use judgment and wisdom and see what does that look like for me, and then make a decision. So then also your horizon again, just make sure you have at least 1 to 3 years so that you see the benefits and continue to invest.
Yeah. I love to talk about goal-based investing a lot because I don't believe in investing blindly. Okay, fine, I'm just putting money aside. Why? What are some of the goals that you feel the Oak Special Fund could help, us in the Kenyan market to really be able to achieve better? Using the fund.
Yeah, so I think things like education for children.
Yeah.
If you just use a compound interest calculator. And do the math.
Yeah.
Like magic.
Yep, I know.
And if you just use a conservative rate of like 12%.
Yeah.
It's like a magic. So if you have like 5 to 10 years before your children are going to school, even less,
even
like 3 years,
you
can use a special fund for that. You could decide, I want to build my home. You can decide to use a special fund for that. Anything that is above a year to 2 years in horizon in terms of a goal, why not? Why not?
I love that, because I love that you mentioned a compound interest calculator. Genuinely, as in when you say magic, I do this with my clients all the time. Like, we do the calculation and they're like, uko sure? Because it's very little, especially for my age mates. Surely, right now, my son just is turning 11 months. By the time we even have to think about school, like the kind of school that is scary, like, let's say, not the PP ones here and there, but like I genuinely feel like from high school and college is where you start feeling it. That's 10 years at least. Look at 10 to 12 years. Very small amounts compounding in the right investment or in the right asset, you're home safe.
I'm telling you. You just need to make sure you've diversified a little.
Exactly.
And you don't have to do so many different things.
Yeah, I love that. So why a lock-in period? Can we talk about, we're still at the risk protection and suitability aspect.
Okay.
So there are two things I think I skipped to ask you about. There's someone who sent me this question. If someone invests in a special fund and something happens, let's say the market crashes, or the fund significantly underperforms, are there any systems or safety nets in place, or should someone plan having in mind that you bear all the risk?
So there's a person themselves, the client,
as the client,
bear all the
risk, or is there like safety in the cases of a market crash or a significant underperformance, like the risk that we were just discussing? Is there like a safety? You see, like how, okay, let me use for example, like you see how the Retirement Benefits Authority has like a system in place in case, let's say, for example, like there's a complete collapse of like a pension fund, because I know there's usually like reserves that the pension funds will put aside. So in the case of special funds, is there like from the special funds perspective, like a safety net in place? Or should I know that if I'm coming into this kind of an asset or these kinds of asset classes, this risk I'm bearing it? It's like how I know I bear all the risk when it comes to like a bond, for example. If there's a default, there's a default. So is that also the case with?
So it's the case. However, for us, what we've said is that each year the maximum drawdown meaning the maximum loss that we are, sort of looking to make sure we don't make beyond is 25%.
Okay.
Yeah, it's 25%. So we use hedging strategies. We have some money in cash and safe places to prevent you from getting more than 25% loss in your investment. That's what we've basically said. However, is there some money sitting somewhere where you invest and we keep it all there? No, we can't do it that way. Otherwise, we won't have money to invest. So it's in our investment strategies where you get protection.
Okay.
And we manage risk in that way through hedging, through diversification in different markets, and making literally decisions every day. Are we staying? Are we moving? Are we staying? Are we, like every day, a daily thing through the day.
Yeah. I love that you mentioned hedging, because there's someone who, I was telling you earlier on, who asked me, who's studied the history of like hedge funds in the United States of America.
Okay.
And he was asking, I struggle to see the difference between the special funds in Kenya and hedge funds.
Okay.
So maybe for the people who do not understand, first of all, what hedge funds are, could you help us maybe break that down? What exactly is a hedge fund? And now tell us if there's any difference, and what is the difference between the special funds we have now and hedge funds.
So again, hedge funds are so different because each hedge fund has its own different strategy. The beauty about hedge funds is they're very flexible, just like I said with special funds. The regulation around them is light. I mean, use that word. And so because of that, they're flexible. They can invest almost in anything. They develop their own strategy. Regulation is light. The minimum investment amount for hedge funds is upwards of $1 million.
Yeah.
So generally. because they want only sophisticated investors and institutional investors.
Exactly.
So that's a hedge fund. Whereas a special fund is heavily regulated. Let me tell you how. We have to have a custodian. So when you send money to us, we don't put it in FIDA bank account.
It can't stay there.
In fact, it doesn't even start there.
Yeah.
You send the money, wire the money to our custodian bank. When we're investing in an asset, we instruct the custodian, send X amount to this investment.
Yeah.
Now, there's another layer, and they're called a trustee.
A trustee, yeah.
The trustee then has to make sure that we're investing in the proportions we said we would. They have our investment policy. They know what we're doing. They get reports and check also, are we doing what we said we would do? They have to see all our advertisements before with our digital strategy, because it's difficult to give everything before for them to approve. We have to indicate what our strategy is. What is our campaign? What are we doing? Then they look at it. They say, okay, fine, this is okay.
This is good.
Yeah, can you imagine all that? We have to do all of that.
And hedge funds don't?
No.
Okay.
Hedge funds don't need to do it because they're not advertising to the public. So hedge funds are not for the public.
Yeah.
They are not. They're specifically targeted at sophisticated professional investors and institutions.
Yeah, awesome. So the difference is regulation.
The difference is mostly regulation and also the type of investor.
Okay.
And finally, the minimum investment amount.
Okay, yeah.
With a special fund, I'm not sure, but regulation-wise, I don't know about the different special funds, but regulation-wise, the minimum is 100,000 shillings.
Okay.
For us, we decided we want a bit higher. And our minimum is 500,000 shillings, and our top-up is much less. Our top-up is 50,000. You don't have to top up, but whenever you're topping up,
that's the minimum.
Yeah. Whereas with hedge funds, we're talking about over 100 million shillings. To be able to participate.
Yeah. All right. Earlier on, I'd asked about the lock-in period. Why is there a lock-in period for more special funds?
Because you see, I want to be able to invest the money in places I can get best return with best opportunity for making that return. So, for example, I enter into forward contract or enter into options. I told you we're doing derivative.
Yeah,
enter into derivative transactions. Or let's say I enter into a transaction where I am putting my money in a fixed deposit. The least amount of time I can put money in a fixed deposit. Because last year, the reason I'm talking about fixed deposits, last year we were making 16% easily.
Imagine.
Yeah, 3 months.
Yeah, you
put a
in and out.
3 months.
Yeah.
So it's 3 months. Now I've put in a fixed deposit. Now you've come after 2 weeks. I need my money.
I want my money back. Now what will you? Yeah.
So I can't get into those sorts of arrangements in terms of, option contracts, fixed deposits, a CP, We're allowed to invest in CPs, commercial paper. Yeah, commercial paper where a company borrows money.
Yeah.
So this company is borrowing for 9 months or they're borrowing for 12 months. I can't get into that transaction so I have to balance how much money is coming in, how much money is going out, and therefore how much do I need to have in cash available for my investors. We don't go into investments beyond 18 months.
I love that.
Yeah, so that we have liquidity.
So that if I come now after the 6-month lock-in,
you get your money back
at any given point in time.
You will get.
So it takes how many? Is it the typical money market fund 2 to 4 working days?
Yes, we take about 48 hours to give it.
That's amazing. Yeah. So like you're getting all this exposure to these good markets and these good assets, but also with that allowance for liquidity if you want.
Yeah.
Okay.
So within 48 to 72 hours for sure, you'll have your money back.
Okay. Would you say that these funds are... I'm just, digging deeper to find out who these funds are really meant for.
Okay.
Would you say these funds are meant for, like, if someone is a beginner investor, because there are words you're mentioning derivatives, you're mentioning, let's say, commercial paper, you're mentioning, there's all these underlying asset classes that are not typical to most Kenyans, right? So would you say that this is an investment that if I'm a beginner, is there a requirement? Like, should I, at least familiarize myself with what are derivatives? What does this mean? What does this other thing? Like, is it meant for anyone? Like a beginner investor, for example? I just got my first job. I'm working with a lot of young professionals right now. Someone is living with their parent. They have minimal bills, if any. You're bagging $4,000 at Microsoft.
Oh my God.
Oh my God. you have your typical money market fund, but you're wondering, now what else can I do?
Come bring your money.
So who can anyone just, like, is there a requirement for me to know? Is it important for me?
We have hired dealers who are complete professionals in what they do. They're the ones who need to know. I mean, we've been in the industry for 30 years.
Yeah.
Okay?
Yeah.
So we don't need, you see, that's the difference and that's the gap. Remember we talked about the gap earlier? Here, we realized that people either don't have the time, capacity, or they're not investing because they don't know.
Yeah.
You don't worry about that. All you need to understand is what the special fund
is and where your money
is being invested.
Yeah.
Just have a general idea. But by the time because we keep communicating, we actually are starting webinars, monthly webinars from this month for our clients. Okay. We're sending out fact sheets. We send out statements every month. And so eventually, inadvertently, they will learn all these different things. However, they're not the ones investing in those things. So they don't need to understand. All they need to know is, this is the return we made, this is where we made it from. If you want to learn more, please, we have tons of videos where we explain the different asset classes, what we're doing, and so on. So, especially for young people, because the time horizon you have
so long. Yeah.
Time is your superpower, as I keep saying. So it would be so awesome if you can decide 50-60% of my income is going to something like that.
Yeah.
And I keep reinvesting. You can retire in a very short time.
Right? Even in 10 years.
Yeah.
Like by the time you're 40, if you're 25 right now, you're probably looking at some form of being work optional.
Absolutely.
Yeah, I love that. Okay, this has been so good, but I have just 3 more questions, right? Right now in the space that we are in the Kenyan industry and in the Kenyan space, of course, this has nothing to do with special funds, but I think it will speak us to our mindset around investing right now. Yeah. So there's definitely a worry. For example, we've noticed that, let's say like the bond, the bond yields have significantly come down. And of course, it's rather obvious that anyone that uses those as the underlying assets, the money market fund returns and whatnot, and I've genuinely noticed which is normal. It's normal human behavior for people to feel like, should I really be investing right now? What would you say to that, and how should people begin to recalibrate how we think about seasons of boom and seasons of, because I feel like from the standpoint of someone who understands economics, that doesn't faze you, because that's how markets are. There's that cycle. Today things are down, today markets are performing well. For someone who is I'm not in the finance industry, I don't know these things, but I'm worried about investing right now because what is happening. So maybe could you help us understand, if you do know, what exactly is happening in the markets right now that is causing this decline in yields, and where should an investor's mindset be? Yeah.
So first of all, from an economic perspective, when yields are very high, you need to have alarm bells ringing. The moment you start seeing a market having yields, returns on government paper, risk-free, 20%, 18%, 17%, run. Well, I don't mean literally, but you need to be like, what is going on?
Yeah.
That is not a good thing. Because it means it's expensive for the government to borrow money.
Yep.
They're going to have to pay much more, meaning now it's going to take much longer for them. They're going to be in a cycle of debt for longer. It's going to be more expensive for us taxpayers, and it's just a mess. So yields coming down is actually a good thing. From the perspective of an investor, it's not because you're not getting as nice returns, but the risk for you of getting your money back when yields are high is much higher.
Yeah. Sure.
Now, it's unfortunate that they see, or people, and I'm agreeing with you because that's the general feeling for us when people come to talk to us, is that, oh my gosh, interest rates, yields are not 12%, they're not 11%, oh my gosh, it's so bad. I'm like, no, it's not. These are fantastic returns. Please step over to the UK or kindly go on the internet and find out what can you get in the bank in the US or in Australia. Take some time to find out what's happening in other markets. Returns must be they're usually as a function of inflation. Okay? When I invest, I'm looking to have my money come back to me higher than inflation. It needs to compensate me for risk. And for the time and inconvenience I'm not using my money.
The
now.
Opportunity cost.
Exactly.
Yeah.
So when inflation is 4%, okay, why should I get 20?
Make it make sense.
It needs to make sense, right? Why are interest rates so high? When interest rates are also high, you find even business people can't borrow. Because it's expensive to borrow. Banks don't want to lend you. It becomes difficult to get loans. And it becomes expensive. You have higher defaults. But when rates come down, then it becomes more affordable to borrow. To do better. The economic environment is actually better. That's what ends up booming. So they tell them not to look at it as things are booming when interest rates are high. In our country, we don't want interest rates to be high.
No.
From an investment perspective, it's nice, but from a larger macro issue,
macroeconomic level,
it's not a good thing. So right now at 11, 12, it's good. And those are good returns. If you just even use that, just go to calculator.net, click on investment calculator and just do the math. It will not take you long. You'll double your money within what? Almost 10 years? Like it's even less, 12%. So I think when inflation then goes up, like average inflation in Kenya, if I look at long-term inflation, it's about 6%. Yeah, it's about 6%. So as long as you're getting above 6%, then you're fine.
Yeah, because you're beating inflation and keeping some. Because if you're getting 11%, then that's like 5%.
Yeah.
I mean, to us, that's maybe, management fees and whatnot. Yeah.
So then don't look at return without inflation.
Return without inflation. I love that you've clarified that, because the panic in the air, genuinely, like it's just like, now let's just put our money in under the mattress, might as well. And Adwant, in your years of experience, what do you think causes us to have this mindset for the fear that comes with is it like a lack of knowing or a lack of understanding? Because I feel like the way some Kenyans approach investing, it's very reactionary. It's almost like, oh, now it's good. Okay, fine, let's invest. Oh, now it's 10%. That's so bad. Might as well put my money in under the mattress. What do you think we should begin to adjust about the way we approach investments? Yeah.
I think, first of all, just understanding, and I loved what you said, that goal-based investing is something that you like to do with your clients, which is fantastic. So that then when you're doing goal-based investing, you're not just looking at this year, this next 1 month, you're looking at, okay, in the next 3 years, I want to be able to do this. I'm getting married in the next 1 year. So when you look at it in that way, in a broader perspective, with the goal or the purpose for why you're investing in mind, then you look at your investments as one full strategy for your life. And I find that when you do it that way, then you're clear around, this is for my protection. And this is what I'm doing to manage for personal risk. This one I'm doing so that I can maintain my standard of living and be able to do these things that I want to be able to continue to do for the foreseeable future. This other thing, I'm taking risk, and it's for, I want to create real wealth. And so I'm going to take. So when you look at it that way, imagine you're not so concerned with 10% or 15%.
Yeah.
Your goal is, where is inflation? Am I beating inflation? With personal risk, it's, am I covering my risk? So you're not even looking at return so much. It's, I am investing in things like even personal development courses, insurance, putting money in insurance. I want to buy a home and things. It's not so much about return. It's about making sure my personal risk is covered. So when you look at investment in that way, and I guess it's a literacy and understanding thing. And I guess you've seen that with your clients. The moment they understand, it's like, oh, I get it now.
I get it now.
Yeah. Then you're not just chasing returns. It's clear, I'm investing in this because this is, at the end of the day, what I'm trying to do.
Okay.
Yeah.
Third and last question, talk to us about the fees and the costs of special funds. I know we call them hidden.
No,
but they're not hidden.
They are not hidden.
No, are they even ever hidden? But let's just, for the sake of the conversation, say any hidden charges that we need to know about, and how should you factor that in when we say, okay, our target is 20%. Is that net? Is that gross? Talk to us about how we should. How should we look at management fees and service charge and whatnot for these funds?
So for us, we have one fee.
Okay.
We don't take any other fee. We don't take withdrawal fees.
Okay.
If we make 50%. Which, I mean, well, you never know. But if we make whatever return we make, our client gets everything.
All right.
We have one fee, and our fee is 6%.
Okay.
Usually people gasp.
Yeah, because we're used to 2% in the money market fund.
What does a money market fund do? It's lazy investing.
For sure.
Deposit the money in that bank.
Yep. Buy this bill. That's it.
To run a special fund.
Yeah.
Do you know sometimes our traders have to go away somewhere?
Oh my gosh.
To just focus and figure out what are we doing. Because they get tired of sitting in the same place and they need fresh air and then you know you can't just get a trader from I don't know which street. All right? It needs to be some
hires
of experience, people who are sober minded, people who are not just from university. So there's a level of experience in the quality of investment managers that we have to have who understand what making an investment looks like and what risk looks like and what risk management, and people who are disciplined who will not decide I have this fantastic idea, let me just do it. Okay? Yeah. That quality of person
very expensive.
Is very expensive.
For sure.
So I'm not trying to hide that. And that's why we decided, by the way, even if we looked at it, we did our financial modeling and we saw that what would make sense for us to continue in this business is to charge a fee that makes sense. And that's why it's 6%. Because we're not doing a money market fund. It is a special fund. We have to have expertise in all these different asset classes I told you about.
Yeah.
And do you have many people sitting waiting for jobs of
no.
that kind?
No.
Yeah. The caliber is high and therefore we have to remunerate in a certain way. And that is why it is 6%. Now, the target is 20. That target is net
of the fee.
So when we report, we've done like in the last 6 months to date, our average return is 18%.
Okay.
For the fund. That 18% is net of our you get that into your, and we deposit our returns every month into your statement, into your account.
Is it compounding? Is it compounded?
So it's a good question. Some things compound, some things don't. So we say it's annual compounding.
Annual compounding.
Because there's some things that, you invest, sell, reinvest that money within 6 months. But then there's others you're holding for 1 year and so nothing happens.
Yeah.
So we say we compound annually.
Awesome. And the tax is still 15% withholding tax.
So the thing about it is that the assets we're investing in are typically taxed at source. So if we buy a bond,
it's already
taxed.
Yeah.
If we buy equities, it's already taxed. The tax is on withholding tax. We don't have, and we buy equities that are listed. We don't have capital gains tax on those.
Okay.
It's withholding tax on dividends. So any dividends we receive, it's already taxed. If we're putting money cash in the bank, it's already taxed. Right? So the transactions that we typically get into are financial market transactions. We're not in real estate. Okay. We're not running business. We're not lending money to people. And so the tax, the tax is already paid at source.
So by the time my 20% is hitting my account, a net of taxes, fees, everything.
Yeah. Oof. Yeah. However, we have different kinds of investors. I would still get you to speak to your tax consultant because people's circumstances are different.
Yeah.
To just analyze for themselves. But otherwise it's net of everything.
Awesome. That is amazing. What else is FIDA doing? I'm so curious because, again, because of, I thank God again for financial literacy, because now I'm seeing more and more people way more interested in doing more than just the money market fund, right? Yeah. So I'm very curious as to, what else are you guys doing? Maybe you can share with us as we close.
Sure.
I know you guys also offer some form of like private portfolio management and whatnot. So just take us through that so that we know, okay, mimi kama nimetosheka na money market fund, nimeweka my pension fund, I've done a few bonds here and there. I want to know what else is in the market that I should think about and consider.
Yeah.
Please plug us.
Yeah. Thank you. So one of the things that we have gotten a lot of questions about is USD. I like the fund, but can I do it in dollars?
Yeah.
So we're launching that next month. So excited about.
Okay, that's awesome. Yeah. Okay.
So we're launching that next month. By the end of July, you'll be able to
invest in USD in the fund. Okay.
Yes. So we have a separate fund. Actually, it's already licensed. It's already approved.
Awesome.
We already have the bank accounts ready. We're starting to invest now. So we will open up for the public next month.
Okay.
The other thing we realize is a lot of people. So there's 2 products we have that people may not know about. there's fixed income funds. But the problem with fixed income funds sometimes is the fact that there's a fee, and then they're buying many different bonds. It's not a bad thing. It's a good thing because you're diversifying across different whatevers, but you find sometimes the rates are lower than being able to invest directly. Sometimes people want the bond in their name and not to be diversified. This is the one I want. I want this T-bill. I have this amount of money available. And so some people feel, no, look, I don't want to go through the hassle of Dow CSD. Okay, which bond did I buy? What is the coupon? So we have a product called Hazina, where we invest directly for you. So if there's a bond that is available, you come open an account with us. We only charge 2,000 bob. You can invest in the bond, and the name on the account is a nominee account. So it is FIDA investment bank account Shiko. Right? So there you will get statements with the central bank logo. Like central bank will send us statements for you. They'll send coupons to us. The beauty about Hazina is that when we get coupon, you tell us whether you want to invest in a money market fund. Do you want to put it in special fund? Do you want to put it in...
You reinvest.
And reinvest it. Do you know what happens when you invest directly in central bank?
No,
the money quietly
goes into your account.
And
you don't even notice.
And the email they send needs to be decrypted by the CBK, please.
They need to change.
Oh, my
transaction change.
Thank you. I'm like,
do you
what
know,
does that mean?
before I figured out those emails, now ujue mimi seti niko green. Nilikuwa nashanga transaction changed, and then 2 seconds later transaction created. Like, just tell me you're paying me or like something. So then you can end up actually swiping that money when you're in the supermarket.
Thank you.
You're just like, and I'm balling. Kumbe unakula interest.
And it's not compounding. So we do that for you.
Awesome. Oh, that is so interesting. Are there fees, like other than the 2,000?
No. Believe it or not.
No way.
The only fee is a transaction fee for the bank, which we pay anyway. So we charge for moving the money from one place to another.
Of course, the IGS.
IGS to pay CBK, blah, blah, blah. We just charge you admin fee of 2,000 shillings for opening the account. Everything else, we're doing for you.
And that's it. My Kenyans in diaspora.
And we have a lot of diaspora. We have a huge...
Would love that.
We have a huge, in the billions, we have a huge account for...
the Kenyans in the...
We realize there's a gap.
Yeah, because it's not easy. Do you know, very often I've had cases of people apply on Dow, unfortunately, and then your application goes through. Now it's time to pay, and you're in diaspora. There's a challenge because unless you have, because you see you have to instruct your bank to make the payment on your behalf. And sometimes that's when my client is discovering, oh, I lost access to my internet banking. So by the time you're now following up on the bank to activate, some banks will even tell you, you need to be here physically for us to reactivate or to activate. If you left the country and you didn't have internet banking already, some banks will not, they want you to be there physically. So I'm in Germany, so there's no way that is happening.
Wow.
Yeah. So I actually had a case of a client who, by the time like that whole mess was being sorted out and they were transferring the money, the deadline had closed. Now we are looking for money because it took us quite a number of weeks for the money to be reversed because the bank says it was already released, but it didn't get to CBK. So I love that you mentioned that because I know Kenyans in diaspora struggle with this. Like, you want to buy bonds, but you're wondering, like, how exactly do I, I know I've opened the account, how do I bid? So do you do also like everything? So you'll notify me as an account holder that, there are these bonds available, or
yes, the one we send out an email. We send out an email and let our clients know there's these bonds available. If you're bidding, because of course, as you know, if you're investing more than 20 million, you have to put in a bid.
Exactly.
We guide you on the bidding strategy as well.
Awesome. And is that both in the primary and the secondary market?
No, that's primary market. So in the secondary market, if you're buying, then of course we would create for you a proposal with the current yields as they are, then you make a decision whether you want to go ahead.
Yeah. Oh, that's amazing. I'm gonna leave the link. Maybe I'll ask you to give us a link to learn more about specifically the Oak Special Fund and any other. I'm gonna leave them in the description box below so that we can engage with those. Any parting words?
Any parting words? Wow, thank you so much for this time. We've had a great conversation. It's always so helpful to have a conversation with someone who has understanding. It's so awesome. It's refreshing. Thank you. My parting shot is wherever it is you are. I know we're talking big numbers, but don't be intimidated by any of those numbers. All of us, we started with 1,000, 2,000, 5,000. Just start where you are with what you can. The important thing is to begin. And I want to encourage you, after you're done with this video, to go and watch. Did you see my video on Larry?
Yeah.
Larry Isa, who started with such little money, just to be encouraged and see that by the way, I don't need a lot to start. And so that's what I would say. If you're thinking about the special fund and you're 31, please slide into
Lucky girl. Lucky
I know,
guys.
You'll be wealthy just now.
I know. Oh, thank you so much, guys. I hope you have enjoyed the conversation today. You guys know I always got you. You asked about special funds. We've had the discussion. Feel free to leave any questions or comments that you may have down below. You guys know what to do. We will take some time and actually respond to them. The description box is full of resources. I'm going to attach how you can reach out to FIDA Investment Bank, the products that they have, how you can get to interact with them, and if you even need a sit down with someone from the bank, we are also going to be leaving all that information down there. Thank you so much. Please remember to share this video with your friends. We are all about getting financially woke in 2025, so don't leave anyone behind. Thank you so much for watching. I'll see you on the next episode of Finance Friday. Stay safe.